What is the most important candle when it comes to trading? There's many thoughts on this topic of what is the most important single candle to focus on to build a strategy around. Now, level 1 trading 101, you're going to be all eyes on the doji candle because that candle shows indecision, a form of rejection, and that's where you need to focus on. And then as you evolve as a trader, you might start to see the candlestick formation patterns, the Japanese candlestick Bible that you've probably seen online. For example, the morning star rejection, an engulfing rejection, or the 3 white soldier candlestick pattern. And then you'll continue to evolve as a trader, bringing you to level 3 in trading, where you'll start to see the opening candles, the 9 a.m. open, the 10:30 a.m. open candle, and how they can actually showcase a form of rejection or based on volatility and liquidity entering on the market open. And then the level 4 candle to focus on. This is when you're starting to mature as a trader. You are looking at the order blocks based on supply and demand, market structure based points of interest, looking at the single candle that caused the break of structure. This is where you get into order blocks, breaker blocks, fair value gaps, and all of these SMC terms. And then level 5, and this is where you get deep into SMC and you start to look at the sweeps, those buy side, sell side, Asia high, Asia low sweep candles. They grab some liquidity and cause a rejection, leaving a nice order block to trade off, but bringing us on to the final candle, the most important candle to focus on, the inducement candle, where it grabs liquidity aggressively and also entices wrong behaviors in the market. It's a psychology play and a liquidity play. And it's important for your trading and profitability to understand the difference and importance between an inducement candle and all the other levels, because these levels can work sometimes, but often they leave you misguided, confused, frustrated, and therefore having inconsistent results in the markets where you sometimes pass a challenge and then quickly blow that account before a payout. So if you're tired of looking at the wrong zones in the markets, not understanding why you're taking losses, here I'm going to break down to you the exact criteria of an inducement candle, how to categorize it, how to optimize it, and how to build a working strategy around it. So let's break down the most important candle in your trading career. So we spoke about level 1 being the doji candle. So the doji candle is a nice form of rejection candle where you expect a bearish market to eventually turn into a bullish market, forming a nice reversal. And within that reversal portion, if you are to zoom out on specific time frames, maybe it's the 1 hour, maybe it's the M15, what is detailed M1 price action of lower lows and lower highs turning into higher highs and higher lows, a bearish market converting to a bullish market. If you are to compress this into a single candle on a higher time frame, you will see a nice rejection. Because in essence, what is a candlestick? A candlestick, if you don't realize, is a indicator technically, because price action is just simply second by second, pip for pip, what was price doing. So as each second goes on, as each minute goes on, price is moving constantly. So the most pure way to look at price would technically be a line chart connecting every price point every second to show you a nice movement of price action. What candlesticks are, they are packaging that into time frames. So the 1 minute time frame is going to show all the movements in a 1 minute time frame, and 1 hour is going to be all the movements collected on a 1 hour time frame. And therefore there is going to be certain markers on a candlestick where you have the open price of where did price open. For example, at 10 o'clock in the morning, exactly at 10 o'clock, where was price? That is our open portion. And then you have the close portion. So at 11 o'clock, exactly where was price? Between the open and close, that forms our body. So the body of the candle is a relationship of the open and close price. This is basically cementing the movement. But then obviously within that candle, you might have an absolute high and an absolute low. So the high and the low of the range is going to be represented as wicks if they deviate away from the open and close. This is going to help us visualize and give some information. Now, this can also sometimes be misleading because we might focus too much on the body, not realizing that price actually went to the high and went to the low. So every portion of the candle has information, but the body or the color of the candle, because green is bullish, so it closed higher than it opened, or in a bearish candle, the red showing danger, showing stop, but also showing that we just closed lower than we opened. This might not be the most relevant information. So therefore I look at the whole candle, but this is simply telling us, let's say price opened over here and price closed over here. So if we are to turn this price action into a candlestick, let's see our open price was here. So we draw it out. And then we say our close price was here. So we draw that out. We also know the low of the candle was down here. So we draw that out as a wick. And we also know the high before the close was here. So we can draw that as a wick also. And then when you collect it all together, you've essentially found a candle where the relationship between the open, close, and the high and the low, this price action over here of a rejection is packaged into a nice doji candle. Now you tell me, what is more detailed? What is more clarity? Understanding the nuances of where the break of structure was, where there's imbalances, where there's liquidity sweeps. Would you rather have all that information on a lower time frame or just one nice 1 hour block, a nice candle? This is how I look at the market in terms of when you're learning to ride a bike, you start off with your training wheels, and then when you get proficient, you take off your training wheels because they will keep you too rigid, and in reality reality, if you want to learn how to ride a bike properly, you need to lean, you need to turn, you're using the full agility and movement of the bike. So same in trading, if you want to have the full flexibility, information, agility, have the full context of what's going on in price, don't take the indicator of a 1 hour candle and just looking at the high and the low and the body. Rather, look at the details of M1 because there's a lot more clarity in there. And this is the lazy way or the beginner way to just see the package price action to use as a guide when you begin. So the conclusion in either case is going to be the same. It's indecision. It's a rejection. But what can be the difference is price can come in. It can start to do this rounding off. You may see a doji candle. I may see a build up, inducement, mitigation. So what I'm seeing is a bearish liquidity cycle. For a candlestick pattern trader, you might see indecision candle, doji. This might give you a rejection candle look. So you might think, okay, it's good to enter the market now. And then the following candle after the mitigation to go lower is just going to be another aggressive bearish candle. So the problem is, it's not giving you full context. Doji does not mean reversal. Price action tells a story. We need to learn how to read it. So it's going to be good, but it'll also be quite misleading. And you're also not getting the full details of the lower time frame of everything that's going on. And these are details you cannot skip. If you don't believe me, watch this channel and you'll realize from the Dancing with Price Action, the 1 minute time frame walkthrough, where I do 3 weeks of price action on the 1 minute time frame, candle by candle by candle. And before I continue on, I want to remind you, in the description I have a series of goodies for you, free downloadable resources that have helped me revolutionize my trading, whether it's my profit taking blueprint where I give you data backed profit taking systems where it's optimal to take profit. In addition, I created an AI powered spreadsheet where you can go through and use my personal risk management OS. It'll give you recommendations on risk, trade types, and how to track through a portfolio in an optimal way. So if you want to grab both of these things, just check the link in the description. I don't want anything from you. It's absolutely free. You can have it for the rest of your life. And I promise you that if you implement it correctly, it will improve your trading and help you towards profitability in your trading journey. Next is going to be the candlestick patterns. This is where you're no longer looking at one candle, but a collection of candles. So here you will find a variety of options. For example, you'll have reversal patterns where they are going to be showing you the market consolidating, reversing, and then engulfing and going the other way. So this will have a name. You'll have another one that will be a bearish candle. And then the following preceding candle will be a large bullish engulfing candle. And you'll start to see all of these variations will have different names, like an engulfing, like the 3 white soldiers, or a morning top like the first one. All of these aren't fine, but just like the doji candle, they are packaging price action for you. And that packaging is not the truth always. Sometimes when this works out and you see, oh yeah, price came to a demand area, gave that morning star reversal, and then the 3 white soldiers to exit. Yes, you identified it correctly, but that's not the reason market moved. It's just showcasing a package of probability that sometimes market reversals look like this, but it's not a fact, because sometimes price comes into a demand area, gives a morning reversal, and then continues bearish. So it's not a truth of the market. It's not a market mechanic. It's just how price is packaged. And sometimes it will showcase truth. Sometimes it will showcase something else. And the problem is, if you don't have the lens to see the clarity and to differentiate a valid doji candle or a valid reversal pattern from an invalid one, you're just looking at the pattern alone, then you are trading just simply patterns, not intellect, not understanding the true cause of the market. And therefore, this is just an elevation of the doji candle. It's a form of training wheels. It's nice in the beginning, but it's not detailed. It's not a science. It's not precise, and will probably not be enough to find actual profitability long-term in the markets. Now, this one can be very powerful because the open of a session, a specific time point in the market, does have meaning because the market is algorithmically delivered and you have institutional algorithms, you have institutional participations, and they usually ladder in the entries on market open. So market open, you'll see a drastic change in volatility, in participation, in orders in the market. And when you see all of this activity, this will give you a sense of information of who of the people that are controlling and moving the markets, whether it's the biggest players, biggest orders, or the ones that can cause the manipulations. When you have the right participants in the markets and their volume at the right time, this can give you an indication of where the day or the session may go. So therefore, at times, this can be really laser sharp. If you see on a London open, you see price tapping into a supply zone aggressively. You might see an Asia range consolidation where price is pinging around during Asia range consolidating. And then you may see price shoot up and then shoot down. On a session open on M15, you might see this consolidation during the Asia range. And before the session, you might see a large bullish candle. And then as the session opens, you see a large bearish reversal candle. So on the London open, for example, you see this bearish engulfing, and therefore you can enter on the close of that candle, stop loss at the high, and you wait wait for price to go lower. And at times this would showcase, like the other formations I'm telling you, it could showcase some reality in the market, but this would again be a reflection of reality, not actually the reality. So sometimes it will be sharp, other times it can be misleading. The only difference is between the doji or the candlestick patterns, this one has something else to show you increased probability, because there is truth that time does have an influence in the markets. So when you are timing a candle, when you are looking for a reversal candle at the right time, this is better than just looking for a reversal candle anytime. So this is going to be better than the others. It's going to be sharp at times, but at other times it will be misleading, because at other times London Open can sometimes be a manipulation and the first move is not the last move. So you have to be careful with this one, because this will certainly give you good win rates, it will give you a good risk reward, but it will not show you true consistency, and overall it might lead to some payouts, but it'll also lead to a lot of blown accounts and confusion, and we don't want that confusion in the market. We want clarity to understand each move, which is why it's important to not look at candlesticks, rather it's important to read the price action of what's going on over here between consolidation, inducement and mitigation. Now the next one is going to be something you're all familiar with, is the most famous one, and is going to be an order block derived from SMC or supply and demand. It's just terminology at this point, but it's going to be explaining the same thing. In a market structure scenario, let's say you have a bearish market structure, you will have a supply zone that is a lower high that broke the previous lower low to make a new lower low in the market. When you have found that bearish main push, you find the origination point, that is your supply zone. And when you focus on this supply zone, you realize on a lower time frame, price was doing the complex pullback to make the lower high and then went on to make the lower low. So you'll see that there is a price action signature over here. And just like in the other cases, you could take the open, close, wick of the high, wick of the low of the candle, and you have found a rejection candle, and that can simply be your candle of choice to be your order block or supply zone. And this can be all types of candles. It can be a large body candle, it can be an engulfing candle, it can be an indecision candle, but we're just looking for the most extreme candle on an M15 or a 1 hour or a 4 hour time frame, the most extreme candle that was the last candle before the price went lower. And this can be seen or worded as the change of state between the last bullish candle and the first bearish candle before a move goes lower, or in other words, the first engulfing bearish candle will be our supply zone, depending on how you do it. Now this is actually something very great. This is actually now highlighting the right area in the market, and you're not looking at this zone for executions like the prior ones. You're looking at this candle for a zone choice. It's a supply zone, and once you arrive to the supply zone, you will look for other confirmations for entries. So this is why I'm okay with this one, because you're not taking a candle and just blindly trading it. You're taking it as a zone, and this is a zone of increased probability, a supply zone where there was impacts, or where there was maybe an inducement, where there was movement to lead to a BOS, historically with the trend, may continue to respect that zone. So if you see an appropriate rejection in that area, you have refined yourself to find qualified zones. This makes total sense. Now, the problem becomes is if you don't know how to read and refine these supply zones, because not all supply zones are equal, and whether it's a doji or an engulfing in that supply zone, all of them will be called order blocks. All of them will be called supply zone, but not all of them are valid. So you need to know all of the differences and not just put them into one category, that is supply zone or order block. And to really differentiate them, you need to learn how to read and refine what happened inside the supply zone, because you can have a supply zone where price went up and then price went down. You can have another supply zone where price went up, consolidated, induced and went lower. You can have another one that's like a V shape, it's just V and down. So all of these things are telling you different information. This is showing me lack of intent. This is showing me institution intent. This is showing me imbalances and orders pending. Each one has a different meaning, protocol, and then where they present is also going to tell me, is it a trap? Is it invalid? Is it weak? Is it strong? So you need to learn all of these criteria and not only blindly follow the candle, because if you don't, you will actually be trading into the liquidity of the market, because market structure is no secret. Everybody knows about supply and demand and market structure. Therefore, so do the institutions, so do the algorithms, and therefore when there's areas of high concentration of stop losses, there is a higher chance of manipulation. That's why you'll see, if you've been following price action for the last decade, like I have, I used to be religiously trading market structure. These order blocks were my favorite thing, but I've seen over the last 5 years, the last 2 years, how it's getting less and less probable and more likely to get induced, which is why we have the whole category from my inducement guide and liquidity guide and my scalp series guide. You'll see from all of these bodies of work, these seminars where I'm going through in detail how market structure is getting induced and leading to my medium inducement protocol and my major inducement protocol. There is a whole playbook based on these inducements. So you've got to learn the differences and details. This is good for a zone selection, but you don't take it as an entry criteria. That is the difference and advice I wanted to give. Now, this is where things are going to get a little bit controversial, but again, I don't have an agenda. I'm not trying to trick anyone. I'm not like trying to mislead anyone. I'm trying to guide you based on what's working for me, what's made me a lot of money, what's allowed me to help thousands of traders either get funded, either get payouts, And within my community, I've helped so many people reach life-changing amounts of payouts or reach $1 million in funding and then find consistency and leave their job. So when I tell you that there is a difference between a smart money zone that will be a smart money sweep and an inducement, you have to realize they are different, because an inducement will also induce these sweep zones. So you've got to be careful, because you will fall into the smart money trap. If you don't believe me, go through the channel where I've showcased smart money traps again and again and again. I did a full video about 30 minutes long, walking through 3 weeks of price action and showing you every day how there is multiple smart money traps on one currency pair. Just one, and it's every day. So you can imagine how prevalent they are, and it's no surprise. If you have millions and millions of smart money traders across the world trading these same zones, of course it will get targeted because there's liquidity up for grabs. So when we talk about it, the typical smart money trader is going to see a zone of equal highs, a double top, a resistance level, and then thereafter they're going to be looking for a candle to shoot up, take liquidity, and then usually a candle to shoot lower, leaving a order block. And when you have this, there is going to be the full qualifications of what's the difference between an inducement and a smart money sweep. Because every smart money sweep that you have and every inducement that you have, you realize every single smart money sweep is an inducement. But not every inducement is a smart money sweep. An inducement is a smaller category inside of SMC sweeps. So that's why sometimes when you trade the SMC sweep, it works because you're likely trading an inducement. But if you don't know the difference, you'll take all of these sweep zones and you'll take loss after loss after loss instead of all of the benefits that an inducement can give you. So it's important to know the difference, and it's going to be categorized by a few things. If you remember the guide that I did, it's going to be categorized about what you're inducing, when you're inducing, how you're inducing, and what happens after the inducement. If you don't break structure, you're breaking the law of cause and effect. The efficiency of the pullback. Watch the guides. If you're trading at the wrong time, for example, a sweep at Frankfurt Open, that is a high probability to be a trap. If you're taking a sweep that is a higher high and you're looking to sell, that is a trap. Higher highs are not supply zones. Lower lows are not demand areas. So you got to know the right time, the right place, the right qualification, and the right context for these sweeps, because these sweeps will appear similar to an inducement, because an inducement may be a buildup of a Asia range, or a buildup of a trend line, or a buildup of previous day high. Whatever the buildup is, after that you're going to get an inducement, price sweeping up and then going lower, price sweeping lower and then going higher. So when you see this price action, this looks the same as a smart money buildup, a smart money sweep, and then looking to sell the order block. It is similar, but it's actually different based on the criteria. You need to know the difference. But just for the premise, you're going to see a local buildup. There is a difference between medium, major, and minor inducements. So you got to know what you're inducing to know the relevance. Is it a zone for me or is it an entry for me? But just to give a bit of context, let's say I have a supply zone of high of previous week, and then price has come back to this area and is shot up and then shot down. This could be potentially an inducement of high of previous week. There's going to be many types, but what we're looking for basically is a zone of liquidity that we qualify. Watch the guide on liquidity. And after that, we're looking for price to shoot up in an aggressive fashion and then thereafter shoot down with a bearish reaction. I need to see an imbalance between candle number 1 and candle number 3. I need to see space between the wicks. I need to see a rejection, and I need to see inducement of something important on the left. When I have found that, I take the highest wick and I take the imbalance of candle number 1. This leaves for me my inducement zone. Now, depending if it's major, medium, or minor, depending on the time, depending on all the context, this will be my favorite candle for points of interest, my favorite candle for entries on the lower time frame on M1 execution. This is my favorite candle. If I see a build up, if I see a sweep up and then price shooting down, I need to see this criteria of engulfing, imbalance, and follow through to lead to a BOS. It needs to make a lower low. When I have that criteria, this is my inducement setup, and just know the difference between that and a smart money zone. That will avoid you taking smart money traps. Again, the purpose of this video is to highlight to you the importance and differences of candles, and more importantly, to remind you, go watch the rest of this channel and all of the guides that I have here on each topic, especially the liquidity and inducement guide, to really solidify what is an inducement, how to qualify it, how to find it, and how to trade it. So go watch the playlist in the description and that will help you out absolutely. And remember, as always, to find profitability in the market, it's not taking more trades, it's not more information, it's not more concepts, it's in less, because the less you do in the market, the more money you make. And when I say less, I mean restrictions, because a restricted trader is a profitable trader.